Hey guys, here we are, another day of our new reality. Today we're going to talk about how the government can stabilize the economy. And the notes that you want are right here. These are what you want. They are in that packet that I emailed to you the other day. You'll kind of see how to fill them out as we go. Um, but anyway, that's where we're at. Like I said, trying to make it easy for you. These notes are set up as you can see. Okay, we're going to talk about two different policies that the government uses. Okay, and if you can keep these two things straight, all right, then you are definitely on the right track. Okay, so you can see, first of all, we've got two columns here. We've got the fiscal policy column, the monetary policy column, and then what you'll see is as we scroll down, there's only going to be two things that the government's going to really try to fix. They're either going to say the economy is moving too fast, we should slow it down, or the economy is not moving fast enough, we should speed it up. So there's only two things that they can try to fix. Okay, and sometimes, as you can see, they'll use different terminologies for what they are trying to do. And so when we try to slow things down, okay, we could call that a leakage. We can call it a tight money policy. Sometimes it's called contractionary policy. And then the same thing goes for when we speed things up, where we can inject money in the economy. We have loose money policy, expansionary policy. You've probably heard the term stimulus plan thrown around a little bit the last few days when the government's talking about what they're going to do to try to combat some of the unemployment that's going to um, take place over the next few weeks. So anyway, the terms, obviously there's several of them, but I don't think they're tricky. And once you get some familiarity with it, and you guys will have an assignment today on my AP. They kind of just ask the same questions in a few different ways as we've seen before. All right, so that's where we're at. Make sure you're emailing me your stuff. You don't have anything to email today necessarily, but you're completing your stuff. Don't be afraid to email me with questions. I know we haven't talked too much. We didn't have anything too new for what we've been getting into, so I know that there's probably not too many questions out there, but there might be some after today, and especially after you get through the MyAP stuff, um, there might be some questions raised. So, just a quick review, okay? And we talked a lot about GDP, unemployment, inflation, okay? And those are the three stats we're going to stick with. So, the nice thing is we have a base. We know about those three particular statistics, okay? We should also remember that unemployment, that's our blue line here, and inflation kind of work, off of each other, right? If unemployment's really low, that means people are making money, right? If people are making money, they're spending it. If they're spending money, prices go up, okay? And so when we see unemployment be high, well, we don't spend money when we're unemployed, and so prices tend to go down, okay? And then as unemployment goes down, inflation goes up. Just a little bit of a historical graph for you there. But we talked about that when we talked about those statistics in the first place. We did mention before too this circular flow of income, and basically what this diagram represents is just how money flows through an economy. So people buy stuff from businesses, right? Businesses hire people, right? And money flows that way. Well, we know the government takes money out, right, with taxes, and they also provide some spending for us in the form of unemployment insurance, welfare programs, whatever the case might be. And the last one that we have to remember too, we haven't talked very much about, we're going to briefly touch on it today, is what banks do. Okay. And the banks are basically have to follow a set of rules by what's referred to as the Federal Reserve. Okay. Which if you've heard of those people before, and they set interest rates. And if interest rates are low, we can borrow more money. If we can borrow more money, we can spend more money. If we spend more money, inflation goes up, et cetera, right? And so the Federal Reserve does some things to affect and influence how much money not only you and I can borrow, but also businesses. Okay, so we've got these four general entities here. You and I, consumers, we got businesses, kind of you and I also, right? Government for sure, and then banks are going to affect how much money we are going to want to or be able to, borrow. Okay, so that's where we're headed. Just real quick, up at the top of your notes there, write it down what's in blue. Okay, we mentioned that trade-off between inflation and unemployment. We're going to throw in unemployment and GDP kind of together. Okay, when unemployment is low, GDP goes up. All right, when unemployment's bad, GDP tends to go down. Okay, and so we're going to keep all three of those stats in there as much as we can. But there is a spot for that on your notes right up here at the top. All right. So let's get rolling here. Okay, we're going to kind of go through a little bit fast. Don't be afraid to pause things, obviously. All right. So here's your two columns. I know it doesn't show up real well. My Chrome extension did not do me too many favors as far as going from a PowerPoint to this. But anyway, I think I've got things fixed. So anyway, so your fiscal policy on the left-hand side there. That's the federal government's use of, they can only do two things. Okay, they can only tax us to affect how much money's in our pocket, and they can only spend money on people to affect how much money's in our pockets. So again, they can either raise or lower taxes for us, okay, or they can give government spending programs in terms of how they distribute that money that way. Okay, so sometimes those programs, the one I didn't mention is military programs. Right, the military buys airplanes from private citizens, right? Or anything that the military buys, and so the government doesn't just spend money on welfare programs and taxing and things like that. They also buy stuff, right? And so whether that be for the military, whether that be cement to build roads or whatever, right? They also buy stuff. All right. Sometimes, and we'll come back to this a little bit later, the federal government affecting the economy is referred to as Keynesian economics. Kind of, that's not how you'd think that word is said, but Keynesian, his name was John Maynard Keynes. And again, just his idea that the government can influence demand for products, okay? And so we're going to use a new term today, this aggregate demand. It's going to be the same as demand for us, okay? But the next day, we will talk a little bit more in depth about this aggregate demand, okay? So anyway, that's what we're trying to influence. So the federal government's got two ways, taxing and spending. The central bank, okay, also known for us as the Federal Reserve, all righty, they affect interest rates, and they can only make interest rates go up, and they can only make interest rates go down. Okay, so they cannot really necessarily do very much with it, but we need to know monetary policy is banking, interest rates, fiscal policy is going to be spending and taxes. You keep those two things straight, you're going to be on the right track to getting a whole lot of questions correct on a test situation. Okay. Sometimes monetary policy is referred to as monetarism. Our central bank is known as the Federal Reserve. I know that my screen got kind of big or kind of small right there. So anyway, the Federal Reserve. All right, let's talk first. Let's talk about slowing down the economy. Okay. And again, we've got our two columns here. Notice on the left-hand side of your notes, right? This is the different terms that we can want to use for slowing down an economy, okay? So anyway, all right, the first thing we've got to understand is if the inflation is too high, we've got to lower demand for stuff, okay? That's what the goal is going to be. So the way the federal government lowers demand for people is they take money out of people's pockets, okay? They can only do it two ways. They can raise taxes, which means if I made less money, if I'm able to take home less money, I'm not going to be able to afford as much stuff. I'm going to stop buying stuff. Or we can stop spending money on things. And so whether that means reducing, welfare benefits, for example, or a cut in military spending, for example, or whatever they decide to do, okay, those are the ways they take money out of our pockets, okay? Now, the positive is that inflation goes down. The negative is that when inflation goes down, we know that unemployment tends to go up, and then our GDP is going to decrease as well. Okay, so there's no perfect magic bullet for the government to fix these things, right? And then you throw in the government debt, and some of the talk about the stimulus program for this coronavirus. They, the debt is an issue, right? And they're talking about what does that debt mean. That's not today's conversation. That's going to be a conversation a little bit later. Okay. Now notice, okay, how your notes are set up. All righty. As you fill them out, the positives for tight money policies, for fiscal policy and monetary policy stay the same. Okay. So you see how your notes are set up here. Hopefully there's some clarity there as you study them. So monetary policy, first of all, we're trying to accomplish the same thing. And when we try to accomplish what we're trying to accomplish is that inflation is going to go down, unemployment is going to go up, and GDP is going to decrease as well. And so the way the banking system makes it more expensive for you to borrow money is they raise interest rates. They've got a few different techniques they can use to do that, but they're going to raise interest rates on those loans, okay, which means I can borrow less money. All righty. So anyway, those are the ways we slow things down. Now, if we want to speed things up, we're just going to do the opposite. Okay. And so if we want to put money into the economy, we inject it, we stimulate it. We have a loose money policy. Sometimes it's called an expansionary policy. Whatever that is we're going to do the opposite. We're going to keep money in people's pockets and allow them to spend it. So the federal government, fiscal policy, they're going to say, all right, we're going to either lower taxes or we're going to increase government spending. Okay. And so again, like we said, we're in fear of this recession that's going to happen, or of a recession occurring here in the next couple months. And, the government right now is already trying to get out in front by increasing spending, creating some type of program where people earn money while they are unemployed or ordered to be at home. Okay. And then we flip our positives and negatives. Okay. If we put money in people's pockets, well, we got inflation a problem. Okay. That's the negative. But a positive is that it's meant to keep lower unemployment. Okay. And our GDP should go up. All right. So just notice that things completely flip from when we tried to slow things down. All right. Monetary policy, they're flipping what they do too. Okay. They're going to lower interest rates. Same positives, same negatives as speeding things up with fiscal policy. Okay. So again, sometimes you hear people say buy money. It's borrowing money. Okay. And keeping in mind that businesses borrow money too. If you talk to your parents about like buying a house and the interest rate and things like that and say, how much does it affect, how much you can borrow? Well, the lower the interest rate, the more money you can borrow to buy a bigger house. Okay. So again, it affects everybody on a day-to-day basis. And it affects everybody on a day-to-day basis, including people and businesses, is what I'm trying to say. All right, last thing here. So down at the bottom, you've got some advantages and disadvantages. Okay, with the fiscal policy stuff, the advantages is that it can be implemented into the economy immediately. Okay, theoretically, they're saying that people have checks in their hands within the next month or something like that. If you've heard some of the announcements that the government's been making, although they haven't came to an agreement in the House and the Senate yet, but they've kind of had some of those things going. They can give money to people right away. Now, like we said, one of the challenges is that right now our government has a lot of debt, right? And maybe Social Security is one of the reasons for that debt. And saying that I'm going to give people money, like that's kind of a popular decision. I don't know necessarily if it would be a smart decision in every single case, right? Not to say that the stimulus is one good thing or bad or good or bad at this particular point, but remember, we talked about, I don't know how many people would vote for a president that said, hey, listen, our economy is doing really well right now. It's probably doing too well. We have some inflation problems. If you guys elect me, I'm going to raise your taxes and we're going to slow this economy down a little bit. That's probably not necessarily a very good strategy to get elected, right? And so, again, they have some reasons why they may or may not want to perform some of those policies. All right. Monetary policy is kind of the opposite. Okay. Is the advantage of it is that we still get to decide how much money we want to borrow, right? It gives us that private ownership of our decisions. Okay. The disadvantage though is, we don't really borrow money on a day-to-day basis like we spend money on a day-to-day basis if we get a check, right? We don't borrow money on a day-to-day basis. And so, these policies take time to to trickle through the economy if that's what's occurring. And so anyway, those are the advantages and disadvantages. Sometimes you'll see a term called supply side economics. So fiscal policy, if you go to your notes, you'll actually kind of see it down here at the bottom. I kind of just gave you a little bit of a side note where supply side economics are arguments against fiscal policy. All right. And again, the idea that if you let people keep money, they invest it to make more money. If they invest it to make more money, it creates jobs for other people, is one argument. Okay. And then the argument against that stuff is, again, it takes a long time for some of those things to trickle through the economy. Right. And, again, the Keynesian economics is the way to try to do it faster. Keynesian economics, FDR, big Keynesian economics guy, right? Really kind of changed how our government runs things. But anyway, I can let you read through that. Your assignment for this stuff is, and I would use your notes, it's pretty straightforward. You are going to my AP and you have an assignment called Unit 3 Fiscal Policy Questions. Okay, so that's what you're working on. I think there's like 15 or 16 multiple choice questions. You should be able to get through those pretty straightforward with using your notes. Okay, so anyway, they should tell you your score. They should. All right. If you have questions, let me know. Okay. We will talk soon. All righty.